Reverse mortgage, what the heck is that? Stay tuned to this episode of Prime Property TV. I promise you, it'll be worth it. Good day, Toronto. Welcome to another episode of Prime Property TV. So glad you could join us here. I finally got a chance to unload some of the footage on the GoPro from the tomato throwing contest I went there to last month. Yes, a tomato throwing contest. Getting a ripe tomato thrown at you in the face really hurts. It was definitely a once-in-a-lifetime event for those adventurous enough to try it. If you ask me if I'm going to go back again, no. But here's some footage for your amusement anyways. In today's episode, I'm going to give you a brief rundown on what a reverse mortgage is. Yes, you heard that right. There's a financial product called reverse mortgage. The technical term for it is a home equity conversion reverse mortgage, or HECM for short, but everyone just calls it a reverse mortgage. It comes up a few times recently for my older clients because it provides those who are over the age of 62 with a guaranteed income using their house as a collateral. Now, if you think about it, if you pay a bank monthly mortgage installments when you buy a property, a reverse mortgage is the bank paying you a monthly income based on the value of your home, up to $625,500. It's a great product for many baby boomers who have bought a house 20 plus years ago in Toronto and are sitting on lots and lots of equity. Many baby boomers are planning on retiring off the equity in their homes. However, there are some drawbacks that I always tell people about, and this is why I'm making this video, and they could be a deal breaker. So you guys decide for yourself. Number one, you're unable to refinance your property. In a real estate market of constantly growing prices, if you are not allowed to refinance your property for appreciation over the next few years, the bank has basically tied up your property and you won't have access to this appreciation and capital. You've kind of effectively sold your property to the bank. This is one of the main reasons I'm quite against reverse mortgages. It's almost better to use a HELOC if you can still qualify one because you may not be working at the age of 62. Or just use existing equity to buy investment properties that will give you cash flow to live off of. That's what I usually recommend. Number two, this one's kind of obvious, interest rates. There will be costs to set up the reverse mortgage, and the interest rate they charge is usually 1 to 2% higher than your standard variable mortgage, which means the bank is making more money off you. Number three, legacy. This one's important. If you plan to leave behind your home as part of an inheritance, you definitely shouldn't be using a reverse mortgage, in my honest opinion. This is because if your heirs want the house back, the loan will have to be fully paid off at a higher interest rate. If the debt can't be settled, then the house has to be sold by the lender. And if there are any extra money, it will go to the estates. So that's just some food for thought if you have kids. Also, the reverse mortgages do if you decide to sell your house. So if you're planning on using reverse mortgage for your retirement, make sure you evaluate those three drawbacks of this financial product. In most cases, I would recommend investing in a cash flow positive property to generate that retirement income rather than using a reverse mortgage, especially if you have time to pick up an investment property before you retire. The benefits of having an investment property far outweigh a reverse mortgage. Just my 2 cents. Thank you guys for watching. If you learned something in this video, make sure you give me a thumbs up. If you like the content, you can subscribe to Prime Property TV. The channel button is right here. And if you have any comments or questions, you can leave them in the comment section below, or feel free to contact me. My contacts will be right here. Until next time, guys, happy real estating.